Hello, and welcome back. I'm your host, Dr. B. This is Principles of Accounting 2. Today we're going to be talking about cost volume profit analysis. This is the concept of breaking even. It is incredibly important for businesses of all sizes, of all types, to understand how much we need to sell in order to break even. We've got to make sure that we cover all of our costs. Let's talk about it. We'll talk about it from the concept of manufacturing, of course. To better understand how costs are identified and how we specify costs, we need to understand how costs behave. You might be thinking to yourself, well, how do costs behave? Costs aren't human. Costs are behavioral in nature. Costs tend to misbehave when they get out of spec or out of range. Costs are identified based off of behaviors or activities. And the behaviors can cause costs to change. So let's think of it from the perspective of activity-based costing that we learned about in previous chapters. Activity-based costing is the allocation of factory overhead based off of activity-based drivers. And activities may change over time, which will cause cost to change. That is a behavior. Similarly, we need to identify costs as they relate to a range of activities over time. As the levels of activities change, the costs associated with those activities will change, and we call that a relevant range, a range of activities. When you hear a range, think of low, medium, high. Right? It's like the low end of the range, the middle of the range, and the high level of the range. Low, medium, high. That is what we call a relevant range. It is an expectation that activities will change within a certain amount. Costs are commonly classified in three different categories. One is called variable costs. We know that variable costs include things like direct materials, direct labor, and factory overhead. Those are the three manufacturing costs that make up a cost of a product. Those are all variable costs. They change with the level of output. Okay? Fixed costs are costs that do not change regardless of the level of output. Example of fixed costs would include things like certain parts of factory overhead, like depreciation expense, rent expense, supervisor salaries. These are fixed costs. They're costs that do not change regardless of the level of output. The third category, and this may be new to some of you, is called mixed, M-I-X-E-D, mixed costs. Mixed costs are a combination of both variable costs and fixed costs together. An example of a mixed cost would be the rental of a piece of machinery. Oh, that's an interesting one. So, with a rental of a piece of machinery, you have a base rent. Okay, it's the amount that you pay regardless of the amount that you're using the machine. Then we would add in what we call overages. So if you go over like 10,000 hours of using the machine, you have to pay overages. It's like your cell phone bill. That could be a mixed cost, right? If you pay by what am I trying to say? If you pay by the usage, what I mean by that is, let's say you have a plan on your cell phone that's 1 gigabyte amount of data, and after you go over the 1 gigabytes, they charge you an additional $10 per gigabyte. Could also be classified as a mixed cost. We'll talk more about it, but I just want to have you a basic understanding of what it is. So variable costs, as you know, those are direct materials, direct labor, portion of factory overhead. Those change with the level of output. That's why we call them variable. Example of variable costs, the company produces a certain number of machines at $10 per unit of direct materials. Direct materials, $10 per unit. We produce 5,000 units, it's $50,000 in direct materials cost. If we produce 30,000 units, that's $300,000 in direct materials cost. We can see that the total cost changes on the direct for the materials based off of the level of output. The more I produce, the more my total direct materials cost is going to be. That's why it's variable. You all understand that. It's a very basic concept. We learned about that very early on. Here's a nice graphical representation of how variable costs look on a graph. The direct materials cost per unit in our example is $10 per unit. That part doesn't change. The cost per unit does not change. The total cost of direct materials does change based off of the level of production. Learning what we learned about in activity-based costing, we know that there are cost drivers for each type of business and each, in fact, activity. Example, for variable cost. The university is the business. The variable cost is the instructor's salaries. The instructor's salaries based on the number of classes the instructor teaches. Go ahead, Drew. Do you have a question?
No. I'm just trying to get back.
Just log
Trying to get back.
Okay, I got you. No worries.
Yeah. Yeah.
Okay. A passenger airline has a variable cost of fuel. That's how the plane gets around, right? And the fuel cost is driven by the number of miles flown. Manufacturing, that's what we, of course, have been talking about, has a variable cost of direct materials. And the direct materials are based off of the number of units produced. And so forth and so on. And for those of you who are in hospitality, and I know there's quite a few of you in our class that are hospitality majors, the type of business is a hotel. The variable cost for the hotel is housekeeping wages. And housekeeping wages are driven by the number of guests staying at the hotel each night. That's variable cost. What about fixed costs? Fixed costs, as you know, are costs that do not change regardless of the level of output. In other words, they stay the same regardless of what happens. Supervisor salaries, depreciation expense, a mortgage, they stay the same regardless of the level of output. In this example, we have a supervisor's salary. This company manufactures bottles of perfume. Okay? Supervisor salary, as we can see, remains the same regardless of the level of output. However, the allocation of that supervisor's salary through factory overhead changes based off the level of output. That part does, right? So we can see that if I produce 50,000 bottles, doesn't matter. My supervisor is still getting paid 75,000. If I produce 300,000 bottles, doesn't matter. My supervisor's salary is still 75,000. The allocation of that supervisor's salary to the bottles produced through a factory overhead, we can see that that decreases with the higher the level of bottles. So at 50,000 bottles, 75,000, that's $1,500 per bottle of factory overhead that gets applied to the supervisor's salary. If the company produces 300,000 bottles, it's only 25 cents a bottle. Interesting, right? That's fixed. So we can see that regardless of the level of output, the supervisor's salary remains the same. The fixed cost per unit is what changes over time, or I'm sorry, over the level of production. The more the company produces, the lower the fixed cost per unit becomes. Looking at activity-based costing, we see that for a university, the fixed cost is the building itself. Depreciation remains the same, and the activity-based number of students. Passenger airline, the airplane itself, depreciation based off of the number of miles flown. Manufacturing, plant manager salary, activity-based number of units produced. For the hotel, the fixed cost is property taxes, remains the same each year, well, most of the time, and it's based off of the number of guests. Fun stuff. Now, to find mixed costs, as I said, are a combination of variable and fixed costs together. That's what makes it mixed. These are sometimes called semi-variable or semi-fixed costs. That's the same term. Mixed means semi-variable or semi-fixed. All that basically means is there's some variable component and some fixed component. Earlier, I gave the example of a piece of machinery that the company is leasing or renting, right? We pay the base lease plus any overages. We'll talk about it. Here's the example. So let's assume that we rent a piece of machinery. The rental rate for the piece of machinery is $15,000 per year, plus $1 for every 10,000 hours over the base. Oh, okay. How do we calculate that? Well, let's take a look at the chart below. If I use the piece of machinery for 8,000 hours, I only pay 15,000. Why 15,000? 15,000 is the base per year. Okay? And 8,000 hours is below 10. If I use it for 12,000 hours, I end up paying 17,000. How did we come up with 17,000? Well, $15,000, that's my base, plus $2,000 for the overage. Earlier I said that the rental agreement says that I pay 15,000 per year plus $1 for every 10,000 hours over the original 10,000. So what that means is I used the machine an additional 2,000 hours over the 10,000 hours base. So 2,000 hours times $1, that's 2,000. So 2,000 plus the 15,000 base gives me the 17,000 paid. 20,000 hours. Oh, that means I got to pay 25,000. 15,000 base plus $10,000 in overages. 28,000 hours minus the 10,000 base times $1. That's 10,000 times $1, $10,000. So 15,000 plus 10,000 is 25. So forth and so on. But this example shows us the mixed cost. The fixed part is the $15,000 per year. That's the base rent. The variable part is the dollar per hour in excess of 10,000. Interesting. It's an interesting concept. And here's how that looks graphically. 15,000 until I hit 10,000 hours. As we go over that 10,000 hours, my rental charges increase $1 for every 10,000 hours thereafter. See how that works? Make sense? That's mixed cost. Very easy concept. Now, we can separate our mixed costs into fixed and variable components, just like we just saw. And we can estimate our mixed costs based off of the high-low method. The high-low method is what we call the relevant range. We'll talk about that. Okay, let's take a look at some data. Okay, our company, in the month of June, we made 1,000 units at a total cost of 45,000. Month of July, 1,500 units, 52,000 total cost. August, 2,100 units, 61,500 total cost. September, 1,800 units, 57,500 total cost. And October, 750 units, 41,250 total cost. Looking at the relevant range, we call this the high-low method. What are my 2 months? Who can answer that question? What's my high month and what's my low month? Don't all answer at once now. Looking at this data, what is my high month and what is my low month?
In terms of cost or units produced?
In terms of cost.
Seems like August is a high month.
That's correct. August is a high month and October is the low month. Very
Yes.
good. Thank you, Richard.
Welcome.
Perfect. So looking at this, August is our high month, October is our low month. So August, 2,100 units, 61,500 total cost. October, 750 units, 41,250 total cost. Using the high-low method, the way it works is we need to find the difference. First thing we do is we find the difference, okay? High minus low. 2,100 units minus 750 is 1,350. That's the difference. High minus low. 61,500 total cost minus 41,250 total cost. The difference is 20,250. Okay, now we found using the high-low method, high minus low equals the difference. That's the first step, yes? Well, the first step is finding the high and the low. Second step is finding the difference. Now that we found the difference using the high-low method, we need to find the variable cost per unit. How we do that is we take the difference in total cost divided by the difference in the units produced. Difference total cost, 20,250, divided by difference in units produced, 1,350, equals $15 per unit. It is my variable cost per unit. That's how we find variable cost per unit using the mixed cost method, or the high-low method. Now, let's take a look to find our total fixed cost at the high and the low method. We know what our variable cost per unit is. So to find the fixed cost, we take the total cost minus the variable cost per unit times the units produced, which gives you the total variable cost. So looking at the high method, or the high level, 61,500 total cost minus variable cost per unit, $15 that we found from step 2, times units produced at the high level, $15 times 2,100 units at the high level gets us to 31,500. Total cost minus our variable cost at the high level equals 30,000. Now we do the same to the lowest level. Total cost at the lowest level are 41,250 minus variable cost per unit, $15 times 750 units at the lowest level. Total variable cost at the lowest level, 11,250. Total cost minus variable cost equals 30,000 at the lowest level. We see that the two are the same. High level, 30,000. Low level, 30,000. Now we need to find total cost. How do we find total cost? We take the variable cost per unit times units produced plus your fixed cost. Okay, ooh, yeah, absolutely. So $15 per unit times units produced plus the 30,000. The 30,000 was our fixed cost. $15 per unit times units produced, in our example, 2,000 units, plus fixed cost, 30,000. That's 30,000 plus 30,000 equals 60,000. Oh, look at that. And that's another great way of actually checking to see if you're accurate. You can take, once you've found your total cost, we know from the high and low method that we had 30,000 at the high, 30,000 at the low. And we can also see that the 30,000 was, the variable was actually equivalent to our fixed. And our total costs are the high and low method added together. That's a way of like verifying, right? But if you follow these simple steps, you'll be able to find your mixed costs. Earlier I said that costs are behavioral. The reason why costs are behavioral is because the cost will go up or down based off of certain activities and changes within things like sales cost, things like that. Variable costs will increase or decrease based off of the changes in the activity level, and the amount per unit will remain the same. For fixed costs, the total amount will remain the same, and the fixed cost will change based off of the activity level per unit, just like we explored earlier on. So here is a nice summation of the types of variable costs, fixed costs, and mixed costs. Variable costs, direct labor, direct materials, some factory overhead. Right? Some factory overhead meaning the related factory overhead that can change over time. Fixed costs are costs that cannot change over time. Straight line depreciation, property taxes, supervisor salaries, insurance expenses. Examples of fixed costs include things like quality control department salaries. It's based off of the number of quality control inspections that the employees in that department make. Purchasing department salaries, based off of the number of purchases that the company makes over time. Maintenance expenses, base plus overage, right? Warehouse expense, base plus overage. Now that we have an understanding of variable costs, fixed costs, and mixed costs, and we understand how costs behave when there's changes, we can now talk about this thing called break even, also known as cost volume profit analysis. The idea behind this is that regardless of what type of cost it is, we are covering all of our costs through sales. Through cost volume profit analysis, I can make decisions based off of my marketing strategies. Oh, I'll introduce a new TV ad to be able to sell more, to be able to cover my costs, to sell more, right? I can help to identify my product mix. This information helps me to set prices. It also helps me to analyze that affects on changes on price. If my price goes down, I might need to sell more. My sales price goes down, I need to sell more. If my sales price goes up, I can sell less. That type of thing. Let's talk about it through this concept called contribution margin. The contribution margin is the excess of sales over cost, over variable cost. To find contribution margin, very simple formula. We simply take our sales minus our variable cost. Sales minus variable cost. That gets me contribution margin. Contribution margin, the way to think about this is gross profit. Gross profit, contribution margin. Oh, I love that word, profit. It's very important in our business, makes profit. The contribution margin covers its fixed cost. Sales minus variable costs equals contribution margin. Contribution margin should cover the total fixed cost. And that point, my friends, is break even. We'll talk about that. Here's a nice example. We have our company sold 50,000 units, a sales price of $20 per unit. We have a variable cost per unit of $12 and a total fixed cost of $300,000. If I sell 50,000 units at $20 per unit, that means I would have sold $1 million in sales. If I sold 50,000 units times $12 per unit of variable cost, that means I had a total variable cost of $600,000. Sales minus variable costs equals contribution margin. Sales, $1 million, minus variable cost, $600,000, equals contribution margin of $400,000. How do we find our contribution margin per unit? It's the difference. So our sales price was $20 per unit. Our variable cost per unit is $12. 20 minus 12 equals 8. That means that we have a unit contribution margin of $8 per unit. $8 per unit times the number of units sold, it's the same, 400,000. Minus contribution margin minus fixed costs equals operating income or loss or break even. Contribution margin was 400,000 minus fixed cost 300,000 equals operating income of 100,000. That's good. That means we made a profit, right? Another important part of this process is understanding this thing called the contribution margin ratio. We know what contribution margin is. Contribution margin is sales minus variable costs. To find the contribution margin ratio, we take the contribution margin divided by total sales. My contribution margin is sales minus variable costs. In our example, it's 1 million minus 600,000. 600,000 was my variable cost, right? So 1 million minus 600,000, that's 400,000. Divided by sales, 1 million. 400,000 divided by 1 million is 40% contribution margin ratio. This tells us the amount of sales dollars available to cover our total fixed costs in order to provide an operating income. Basically what this ratio tells us. And it's very useful. It helps us as managers to best understand the overall condition of the business as it relates to sales. As time goes on, the more I sell or the less I sell, there's going to be a change in my sales dollars, obviously. And to find that change in sales dollars or a change in operating income, I take the change in sales dollars times the contribution margin ratio. If my company sells an additional $80,000, because for whatever reason, we sold an extra $80,000. Great, that's fantastic. Because remember, um, by selling, we had originally sold $1 million worth of inventory. But if we sell an additional 4,000 units, it means we'll make an additional, we'll have a additional 80,000 units, or I'm sorry, $80,000, which means we'll have an additional operating income of 32,000. How did we find this? Change in sales dollars. I sold an additional 80,000, so the change is 80,000. Times contribution margin ratio, 40%, equals $32,000 of change in operating income. Looking at it graphically, I sold an additional $80,000. I originally sold 1 million. Now I sold 1,080,000 worth. I sold an additional 4,000 units. Originally I sold 50,000, now I sold 54,000. 54,000 units times $20 is 1,080,000. Minus total variable cost, 648,000. We see the 648,000 is obviously changed. 648,000. How we got there? 54,000 units sold times $12 per unit of variable cost. Sales minus total variable cost equals contribution margin, 432,000. 54,000 units times $8 per unit. $8 per unit is the variable cost. The contribution margin per unit. Sales minus variable cost equals contribution margin. We could do that in sales dollars and in individual units. $20 per unit sales price minus variable cost per unit, $12, equals contribution margin of $8 per unit. Our fixed cost, 300,000, contribution margin minus fixed cost, 300,000, equals an operating income of 132,000. That's pretty good, if you ask me. So now we understand how contribution margin works. Let's talk about unit contribution margin. You need to understand it from the whole company perspective and the individual unit perspective, because some companies sell more than one type of product. So unit contribution margin, sales price minus variable cost per unit equals contribution margin per unit. $20 per unit sales price minus $12 per unit variable cost equals $8 per unit contribution margin. And you do the same thing to find the change. This helps us to find the change in the operating income. What we do is we look for the change in unit sales times the unit contribution margin. Change in unit sales comes from selling more or less of inventory. Let's say that we had an increase in the total of units that we sold from 50,000 units to 65,000 units. That means we sold an additional 15,000 units. We take that 15,000 units times the contribution margin of $8 per unit, gives us a total change in operating income of 120,000. Here's how it looks. So as I said earlier, I sold an additional 15,000 units. Originally we sold 50, now we sold 65. 65,000 units times $20 per unit, 1.3 million. The variable cost, 65,000 units sold times $12 per unit, 780. Sales minus variable cost equals contribution margin, 520,000. Minus fixed cost, 300,000. Equals operating income, 220,000. Pretty good. How do we find the break even? The break even point tells us how much of something or how much I need to make in order to cover all of my expenses. This is the most critical formula in business. Why? Because it tells us how much I need to sell in order to cover all my expenses, so I don't lose money. Okay? We can find the point of break even in units and sales dollars. Break even is the point where revenue equal your expenses. You neither made a profit, but you also didn't lose any money. That's break even. It's where your sales minus expenses equals 0. That's break even. Okay. The formula for finding break even in terms of the number of units I need to sell is we take your fixed cost divided by the unit contribution margin. When your sales equal your costs, that's where you make break even. I said that to find break even in terms of units, we take our fixed cost divided by our unit contribution margin. Now here's some example. Fixed cost for our company, 90,000. Our unit sales price, we sell each unit for $25. Our variable cost per unit is 15. Sales price minus variable cost per unit equals contribution margin per unit. 25 minus 15 is 10. So we have a unit contribution margin of $10 per unit. Our fixed costs are 90,000 divided by our unit contribution margin of $10 per unit equals 9,000 units. What that means is I need to sell 9,000 units of this product to break even. How does that look in terms of sales dollars? If I sell 9,000 units at $25 per unit sales price, that means I'll make $225,000. My variable cost per unit is $15. 9,000 units times 15 is 135. 225 sales minus variable cost of 135 equals contribution margin of 90,000. My fixed costs are 90,000. So contribution margin minus fixed costs equals operating income. 90,000 minus 90,000 is 0. Therefore, I have broken even if I sell 9,000 units. Make sense so far? Yes? Great. Thank you so much. Excellent. Thank you. Thank you, Dylan. So yeah, now we have this basic understanding of how to break even. We know how to do it in units. Now let's talk about how to do it in sales dollars. In sales dollars, it works the same way. The difference is we're talking about the sales dollars, not the number of units. Okay? To break even in sales dollars, we take the fixed cost divided by the contribution margin ratio. As you recall, the contribution margin ratio in terms of I'm sorry. For the contribution margin ratio, to find it, we take unit contribution margin divided by unit sales price. To find unit contribution margin, you simply take unit sales price minus unit variable cost. That gets you unit contribution margin. Sales price minus variable cost gets my unit contribution margin divided by sales price. So here's how it looks in our example. My unit contribution margin is $10. $25 sales price minus $15 variable cost equals unit contribution margin of $10 per unit divided by sales price, $25 per unit. My unit contribution margin ratio is 40% per unit. Okay. Now, if I apply that to the break even for sales dollars, my fixed costs are $90,000 divided by my contribution ratio of 40%. That means I need to sell $225,000 in order to break even. It makes sense, right? Sales, how much I need to sell to break even? We learned about it, how to do from both units, and now you know how to do it for sales dollars. Excellent. Okay, now let's talk about what happens when things change. Things always change, right? Especially price. If my sales price, okay, but what happens when there's a change in my fixed costs? Uh, as you know, fixed costs do not change regardless of the level of activity. Level of output changes, my fixed costs remain the same. Fixed costs always remain the same. What if my fixed costs change? Fixed costs might change if I run a TV ad, or I have an increase in my property taxes, or I have to pay supervisor salaries more. Therefore, my fixed costs change. When my fixed costs change, there will either be an increase or a decrease in fixed costs, and there will be an increase or decrease in the break-even point. If my fixed costs increase, my break-even point increases. If my fixed costs decrease, my break-even point decreases. Fixed costs go up, break-even goes up. Fixed costs go down, break-even goes down. That's if there's a change in fixed costs. So let's say my company is going to run a TV ad for $100,000. Okay. Right now, before the TV ad, my current sales price is $90 per unit. I have a variable cost of $70 per unit and a contribution margin of $20 per unit. My fixed costs are $600,000. If I run the TV ad is a fixed cost. My fixed costs go up to $700,000. Everything else remains the same. Okay? So what that means is I need to sell more. Clearly, I need to sell more. Fixed to find break even in sales units. 600,000 fixed cost divided by contribution margin, $20 per unit. I need to sell 30,000 units to break even currently. If my fixed cost increases by $100,000 because I'm running a TV ad, fixed cost 700,000 divided by unit contribution margin 20. I need to sell 35,000 units now to break even. Would that change? So my fixed cost went up, therefore I need to sell more. That means my break even went up. What if my variable costs change? I have an increase in price of direct materials. I have an increase in hourly wages. I need to pay my salespeople more. Those are variable costs. Variable costs go up. I need to sell more. Variable costs go up. Break even goes up. Variable cost goes down. Break even goes down. So fixed costs go up. Break even goes up. Variable costs go up. Break even goes up. So fixed and variable costs, they have the same correlation as it relates to break even. Here's our example. Current sales price, $250 a unit. My current variable cost per unit is $145. Gives me a unit contribution margin of $105. My fixed costs are $840,000. My salespeople want more money. They want an additional 2%. So they want an additional 2%. That means my variable cost goes up. Current sales price, $250 per unit. if they want an additional 2%, that means I got to pay them an additional $5. My variable cost goes up by $5 per unit. Okay, 145 plus a 2% change. 2% change is $5 off of the current 145. A 2% change of $250 is $5. I just moved my 150. $250 sales price minus 150 variable cost. My unit contribution margin went down to 100. Fixed costs remain the same. So currently, I need to sell 8,000 units. 840,000 fixed cost divided by 105 contribution margin is 8,000 units. If I pay my salespeople an additional 2%, I need to sell 8,400 units. 840,000 fixed cost divided by unit contribution margin, $100 per unit. That means I need to sell another 400 units. Make sense? This is very easy. Yeah, thank you. Awesome. Again, it's one of my favorite topics because we're talking about making money and breaking even. Okay, what about, and this is where it gets a little different. Okay, we talked about changes in fixed costs. We talked about changes in variable costs. What if our sales price changes? We put it on sale, or we raise the sales price. If we raise the sales price, our break even decreases. If we decrease our sales price, the break even increases. So this one has an inverse relationship. Fixed cost and variable cost, they have the same relationship. One goes up, the other goes up. For sales price, this is the only one where the relationship is inverse. Sales price goes up, break even goes down. And the opposite is also true. Let's say I want to raise my sales price. Oh, it's real popular. I'm selling a lot of them. Let's raise the sales price, make a little bit more profit. Oh yeah, that's what I'm talking about. So current sales price, $50 per unit. Variable cost, $30 per unit. Contribution margin, 20. Sales price minus variable cost equals contribution margin. Let's raise our prices by $10 per unit. Oh yeah, let's make a little extra profit. So $60 sales price minus $30 variable cost equals $30 unit contribution margin. Right now, I need to sell 30,000 units to break even. But if I raise my sales price by $10, that means I raise my contribution margin by $10. That means I only need to sell 20,000 units to break even if I do that. Not a bad idea. All right. So again, showing the relationship when there's changes in fixed cost or variable cost, they correspond with each other with break even. The only difference is unit sales price. Unit sales price increase, break even decrease. Unit sales price goes down. That means I need to sell more to break even. Now let's talk about this other awesome concept called target profit. Target profit means how much profit do I want to make? That's my target profit. How much I want to profit. Everyone likes a profit. So to find how much you need to sell in order to achieve a certain profit, we take the fixed cost plus the target profit divided by unit contribution margin. So let's say you're like, hey, I own this catering business. I'm like, you know what? This year I want to make $100,000 in profit. What do I need to do to make that happen? Well, you take your fixed cost plus your target profit of $100,000 divided by your unit contribution margin. So here's how it works. Fixed costs are $200,000. Target profit, $100,000. My sales price is $75. My variable cost is 45. That makes my unit contribution margin 30. Sales price minus variable cost equals contribution margin. So, using my formula, I take my 200,000 fixed cost plus my target profit of 100,000 divided by unit contribution margin of 30. That means I need to sell 10,000 units in order to achieve a target profit of $100,000. Here's how it looks on your income statement. Sales minus variable cost equals contribution margin minus fixed cost equals an operating income of 100,000. The operating income of 100,000 is your target profit. We can look at that in another way through sales dollars. How much sales dollars do I need to make in order to achieve a target profit of 100,000? It's the same concept, okay? First, we find our contribution margin ratio. Contribution margin, $30 divided by sales price, 75, that's 40%. To find the sales dollars, to get 100,000 target profit, we take fixed cost plus target profit. So 200,000 plus 100,000, that's 300,000. Divided by contribution margin ratio, 40%, equals $750,000. I need to sell $750,000 worth of sales to achieve a target profit of $100,000. Isn't that awesome? I love it. Now, of course, I can chart this data to help me to identify my point of break even and what that all looks like based off of sales costs and if we make a profit or a loss. There's a bunch of steps to create a chart. Don't worry, I'm not going to have you create a chart. I do want you to understand how to read the chart though. So here are the steps to create the chart. So let's take a look at the chart. Fixed cost 100,000, sales price 50, variable cost 30, gives me unit contribution margin at 20. Now, if we take a look at this chart, I need to sell $250,000 or 5,000 units to break even. Anything over that is a profit. Anything under that is a loss. Basically helps you to read the chart. How do you determine variable cost? Variable cost, you know what variable cost is. That's direct labor, direct materials, factory overhead. That's the cost of manufacturing your product. It'll be given to you. But sales price minus variable cost equals contribution margin. Good question. Break-even point for our company's 250,000, 5,000 units. Break-even is in the middle. If you go over your break-even point, that's a profit. Under your break-even point, that's a loss. You always want to be above. Here's again the graphical representation of this. Unit sales, and costs. So that's your idea. Another graphical approach called a profit volume chart shows us the difference between sales and costs. Here are the steps to create that chart. Here's our data. Fixed cost 100,000, sales price 50, variable cost 30, contribution margin 20. We want to make a target profit. We have a target profit of 100,000. Sales minus variable cost equals contribution margin minus fixed cost equals operating income. If I graph that out, how did I get my 100,000? Fixed cost here, you see how it works, right? I sell 8,000 units to get $60,000 profit. 0 and 5,000 is break even, and then of course there's the loss. I just kind of showed you how that all works. But just remember the concepts. Sales minus variable costs equals contribution margin minus fixed costs equals operating. And here's a comparison of those charts. I'm not going to have you create charts. It's good. It's important to know how to read them because you'll see them. It'll be on the final exam. The chart will be anyway, or it might be on the quiz. And like, oh, here's a chart. How do I read the chart? Now you know how to read the chart. One thing earlier thing I talked about is called a sales mix. This is the different products that the company sells. If the company sells more than one product, you do the same thing to each product. Sales price minus variable cost equals contribution margin per product. Define the sales mix. How do you find the sales mix, you might be asking? It's based off of the number of units sold for each product. Okay, how do we find the percentages? Product A is 80%, product B 20%. How do we find those percentages? Well, you take the units sold for that product divided by the total number of units sold for the whole company. So 8,000 divided by 10,000 is 80%. How do I find 10,000? We added products A and B together. 8,000 plus 2,000 is 10,000. Product B, sales mix is 20%. 2,000 divided by 10,000, 20%. And that's what that looks like. 80% product A, 20% product B, you see 100%. And for sales analysis, that helps a company to kind of identify, their product mix. If you add the two products together, we get product E. So sales price for each product times a respective sales mix percentage. So $90 sales price times 0.8. Why 0.8? Because product A makes up 80% of the sales mix. 90 times 0.8, 140 times 0.2. You add those two together to get the average for the whole company. Product E represents the whole company. Yeah. Product E is the average. $100 average minus $75 average variable cost equals an average contribution margin of 25. And the averages are based off the sales mix. To break even for the whole company, I need my fixed cost for the whole company is 200,000 divided by unit contribution margin for the whole company, $25. Means I need to sell an average of 8,000 units of each product to break even. And that's how this looks great. Last concept to understand is called operating leverage. Operating leverage provides a company with what we call leverage. This is where our contribution margin and our operating income factor into leverage. Contribution margin divided by operating income. Contribution margin, as you know, is sales minus variable cost equals contribution margin divided by operating income. The higher the leverage, the better. Contribution margin minus operating income equals fixed cost. Fixed cost for companies with higher fixed costs are said to have higher operating leverage. Sales minus variable cost equals contribution margin minus fixed cost equals operating income. To find the operating leverage, we take your contribution margin divided by operating income. The higher the leverage, the better. And of course, you can find percent changes in operating income. To find percent change, you take the new number minus the old number divided by the old number. That gets you the percent change. Percent change in sales times the operating leverage equals a percent change in the operating income. Percent change in sales times the operating leverage equals a percent change in operating income. Yeah. One more thing to know: margin of safety. Margin of safety is exactly what it sounds. If I have a margin of safety, that means that I can safely identify the point before I start to lose money. Don't want to lose money. To find the margin of safety, you take your sales minus the amount that you need to sell at the point of break even divided by sales. Sales minus the point that you need to sell in order to break even divided by sales. And that will give you your margin of safety. And of course, we can do we can apply the same concept to service businesses like hotels. With a hotel, the break even is based off of the number of guests that stay at the hotel during a time period. That gives you an example of how we do it in service. Any comments, questions, concerns as we talk about break even? Anything that you hope that we would have covered that we did not? Or any other questions that you can think of? No, you good? Okay. So what?
Yeah, Professor. Yeah, so far it's good. Yeah, thank you.
Awesome. That's great. Thank you so much. Of course the session is recorded. They all are. You know that. Okay. Looking back at what is due, when's it due? We're in week 3 now. Okay, week 3. You have your chapter 19 quiz and your chapter 20 homework assignment. Remember, there are 2 things due in every single week. Make sure you do both of those things. That's the only way you're going to pass, is to do the work. If you think of any other comments, questions, or concerns, please feel free to email me, call me, set up office hours with me. I'm always here and available for you. So thank you all again so very much for your time. Stay safe. Wash your hands. Do the right things. Thank you all so very much for your time. Thank you, thank you, thank you. Enjoy the rest of your day. Take care now.
Take care.